What if the biggest financial mistakes of your life are completely invisible to you? We spend our lives agonizing over the bad decisions we made. The stock we bought that went to zero, the business venture that failed, the house we bought at the peak of the market. These are our scars, the stories we tell. They are our errors of commission. They are the mistakes of action. And Warren Buffett, arguably the greatest capital allocator in history, is telling you that your focus is entirely wrong. He has stated repeatedly and without ambiguity that his errors of commission, the bad investments he actually made, have cost him relatively little. In contrast, his errors of omission, the brilliant investments he understood, analyzed, and then failed to make, have cost him, and the shareholders of Berkshire Hathaway, not just millions, not just billions, but hundreds of billions of dollars. These are the ghost ships of fortune that sailed by fully loaded with treasure that he simply failed to board. This is a profound and deeply unsettling idea. It suggests that your financial reality is shaped less by the mountains you tried to climb and fell from, and more by the entire mountain ranges you saw in the distance and never even attempted to approach. It's a challenge to the very way we measure success and failure. The world punishes visible mistakes. Your boss, your spouse, your friends. They see the money you lost on a bad bet. No one sees the fortune you forfeited by not making a great one. This asymmetry in our world creates a powerful, silent incentive toward inaction, a gravitational pull toward the safety of the known, the comfort of the sidelines. But on the sidelines, no games are won. The cost of this invisible mistake, this failure of conviction and courage, is the quiet compounding of regret, a phantom liability on your life's balance sheet that can grow to eclipse all your other financial achievements combined. This is not a conversation about investment tips or stock picks. This is a conversation about the architecture of decision-making under uncertainty. It is a deep dive into the psychology of conviction, the courage to act, and the discipline to learn from the opportunities you let slip through your fingers. We will deconstruct the 5 fundamental pillars of this concept, using the life and mind of Warren Buffett as our guide. We will move from understanding the anatomy of this mistake to building the mental and emotional fortitude required to ensure that when the opportunity of a decade presents itself, you are not the one left on the shore, watching the ship disappear over the horizon. This is about learning to see what isn't there. It's about quantifying the cost of what you don't do. It is about the final promise you must make to yourself, to never let a lack of courage be the reason you miss your destiny. The very first step on this journey is to perform an autopsy on an invisible failure, to understand the precise anatomy of an error of omission. It is not enough to say you missed an opportunity. The world is filled with infinite opportunities. No one can seize them all. Buffett's definition is far more rigorous and painful. An error of omission occurs only when an opportunity meets 3 specific criteria. First, it must be within your circle of competence, something you are capable of understanding. Second, you must have analyzed it and come to the correct conclusion that it was an attractive investment. And third, you failed to act or act aggressively enough due to some psychological friction, fear, greed, or, most often, the simple folly of haggling over a pittance. To truly grasp the weight of this, we must travel back in time to a dusty town in Arkansas and witness one of the most monumental financial blunders in modern history, a mistake that cost Berkshire Hathaway a sum so vast it is difficult to comprehend. It is the story of Warren Buffett and Walmart. In the late 1960s and early 1970s, Sam Walton was building a retail empire from the ground up in Bentonville, Arkansas. His business model was revolutionary in its simplicity: build large stores in small towns, offer the lowest prices, manage inventory with ruthless efficiency, and cultivate a culture of frugality and customer service. Warren Buffett, for his part, was already a highly successful private investor, managing his partnership with a focus on simple, understandable businesses with durable competitive advantages. Retail was squarely within his circle of competence. He understood branding, logistics, and the power of a low-cost operator. More than that, he had a personal connection. Through a mutual friend, another retailer named Saul Price who founded FedMart, Buffett had been introduced to the legend of Sam Walton. He heard stories of Walton's obsessive focus, his beat-up pickup truck, his almost fanatical devotion to driving down costs. This wasn't some abstract concept. This was a business model Buffett was genetically engineered to appreciate. In 1973, the opportunity to act arrived. Walmart, which had gone public in 1970, had a market capitalization of around $250 million. By today's standards, a tiny sum. Buffett had the capital, he understood the business, he admired the founder. He and his partner, Charlie Munger, analyzed the company and correctly identified it as a juggernaut in the making. They saw the unstoppable force of Walton's strategy. They knew it was a phenomenal business. So what happened? The answer is a case study in the destructive power of being penny-wise and billion-dollar foolish. The stock was trading at a certain price, and Buffett, a hardened bargain hunter, wanted it for just a little bit less. The difference they were haggling over was, by his own admission, negligible. It might have been 1/8 of a point, a fraction of a dollar per share. He and Munger talked it over. They decided the price was just a touch too rich for their blood. So they waited. They passed. They did nothing. They committed a catastrophic error of omission. To understand the magnitude of this decision, we have to look at the numbers. Had Buffett invested a significant sum in Walmart in 1973, let's say a few tens of millions of dollars, that stake, through stock splits and the meteoric rise of the company, would have grown to be worth well over $100 billion today. Let that number sink in. $100 billion. For perspective, that single missed opportunity is larger than the entire market capitalization of companies like Goldman Sachs or Starbucks. It's a sum so large that it would have fundamentally changed the already legendary trajectory of Berkshire Hathaway. Buffett has since referred to this as one of his greatest mistakes, a thumb-sucking decision of epic proportions. Charlie Munger is even more blunt, calling it a multi-hundred-billion-dollar blunder when you account for the opportunity cost of what they could have done with that capital. This wasn't a failure of analysis. Their analysis was perfect. This was a failure of action. A failure of courage. They let a microscopic disagreement over price cheat them out of a generation-defining investment. This is the perfect foundational anecdote because it contains all the poison of an error of omission, full understanding, correct analysis, and a final, fatal moment of hesitation. It's a ghost that haunts the halls of Berkshire Hathaway, a silent reminder that the greatest risk is not always in the action you take, but in the brilliant action you fail to take. The Walmart story is not just a business case study, it's a window into the deep, often irrational wiring of the human brain. To understand why two of the most brilliant financial minds on the planet would make such a colossal error, we must delve into the underlying psychological principle at play, a powerful cognitive distortion known as omission bias. Omission bias is our inherent tendency to judge harmful actions as worse, or less moral, than equally harmful inactions. Imagine two scenarios. In scenario 1, a person knowingly sells a faulty product that harms a customer. In scenario 2, a person sees a faulty product on a shelf and, knowing it could harm someone, says nothing and walks away. Most people would judge the person in scenario 1 far more harshly, even if the harm caused is identical. The act of commission, of doing something wrong, feels more culpable than the act of omission, of failing to do something right. This bias is hardwired into our social and legal structures. We have laws against doing bad things. We have very few laws that force us to do good things. In the corporate world, this bias is magnified 1,000-fold. A CEO who launches a new product line that fails spectacularly and loses the company $100 million might be fired. His mistake is visible, quantifiable, and embarrassing. It's an error of commission. Now consider a different CEO. He is presented with a proposal for a revolutionary new product line. His team has done the research, it has massive potential, but it's risky, it's unproven. He decides not to pursue it, 5 years later, a competitor launches the exact same product and builds a $10 billion business around it. Has the first CEO made a mistake? Absolutely, a $10 billion mistake. But will he be fired? Almost certainly not. His error is an error of omission. It's invisible. It doesn't appear as a loss on the income statement. There is no embarrassing press release. He can defend his inaction with appeals to prudence and risk management. Our entire system of rewards and punishments is geared to encourage this kind of behavior. It implicitly tells every decision-maker, it is far safer to miss a massive opportunity than it is to be seen failing at a new initiative. This creates a culture of corporate cowardice, where the primary goal is not to win, but to avoid losing visibly. Buffett and Munger, despite their intellectual prowess, are still human. In 1973, the pain of overpaying for Walmart by a small fraction and seeing the stock go down in the short term, a visible error of commission, weighed more heavily on their minds than the abstract, astronomical future gains they might be foregoing, the invisible error of omission. The fear of looking foolish in the near term overpowered the logic of being brilliant in the long term. This is a battle that plays out in the mind of every investor and entrepreneur. Every time you have a great idea but hesitate, every time you analyze a stock you love but wait for a slightly better price, you are in the grip of omission bias. You are subconsciously calculating that the social and psychological cost of a failed action is higher than the financial cost of a successful inaction. Breaking free from this bias requires a conscious and deliberate rewiring of your mental software, a shift from focusing on the return time times capital to focusing on the return time your uninvested time, attention, and conviction. It requires accepting that in the game of long-term business growth and wealth creation, the sin of timidity is far greater than the sin of measured error. So how do we translate this psychological insight into a practical tool? How do we build a mental model that allows us to override this dangerous default setting in our brains? The blueprint can be found in a framework famously articulated by Jeff Bezos, but its core logic is universally applicable to any high-stakes decision. It is the regret minimization framework. The model is not a complex financial calculation, but a powerful thought experiment designed to shift your perspective from the short-term anxieties of the present to the long-term wisdom of the future. It's a systematic way to combat omission bias by forcing you to confront the true, lifelong cost of inaction. Here is the applied mental model, broken down into a step-by-step process that you can use for your next major investment or business decision. Step 1. Clearly define the opportunity. This is not for trivial matters. This is for the big ones, the Walmart-level opportunities that appear only a few times in a career. You must first confirm it is squarely within your circle of competence. Write down, in simple language, why you believe this is a phenomenal opportunity. For Buffett with Walmart, it would have been, a fanatically driven founder is building a low-cost retail machine that is systematically conquering small-town America with a business model that is both scalable and protected by a deep competitive moat. Step 2. Acknowledge and quantify the risk of commission. What is the absolute worst that can happen if you act and you are wrong? In most investment scenarios, the answer is you lose 100% of your invested capital. Be honest about this. If you invest $1 million, you could lose $1 million. Stare that possibility in the face. This grounds the decision in reality and respects the downside. Step 3. Attempt to quantify the potential cost of omission. This is the crucial and often neglected step. What is the realistic long-term upside if you are right? This requires you to think not about next quarter, but about the next decade. What is the total addressable market? What is the company's growth rate? How powerful is its moat? For Walmart in 1973, a thoughtful analysis would have revealed a path to thousands of stores and national dominance. The potential upside wasn't 50 or 100%. It was 10,000% or more. The cost of omission was not the small amount they might have overpaid. It was the forfeiture of a stake in one of the greatest wealth creation engines of the 20th century. You must put a plausible number on your potential regret. Step 4. The final and most important step is to project yourself forward in time. Imagine you are 80 years old, sitting in a rocking chair, looking back on your life. Now ask yourself the question, in this future state, which will I regret more? Making this investment and having it fail, losing my entire stake, or passing on this investment and watching it become one of the monumental successes of its generation, knowing that I understood it and just failed to act. This simple act of time travel is psychologically profound. It strips away the short-term noise, the fear of a temporary stock dip, the worry about what your peers might think, the ego attached to getting the perfect price. From the vantage point of age 80, these things are revealed to be trivial. The only thing that will matter is whether you took your shot at the truly great opportunities. In almost every case of a genuine, well-understood fat pitch, the regret of omission will loom infinitely larger than the regret of commission. This framework doesn't guarantee success, but it does guarantee that you are making decisions based on the right set of values, prioritizing long-term achievement over short-term social comfort. It's the antidote to the paralysis that cost Warren Buffett $100 billion. To truly appreciate the wisdom of this approach, we must shine a harsh light on its opposite, the antithesis, the path walked by the 99% of investors. This is the path of obsession with the visible, the tangible, and the immediate. The average investor's entire financial world is defined by their errors of commission. Their focus is solely on their portfolio, the collection of stocks and assets they have actively chosen to buy. They check it daily, even hourly. A green day brings a jolt of pleasure and self-congratulation. A red day brings a spike of anxiety and doubt. Their entire emotional and intellectual energy is consumed by managing these small, visible actions. They agonize over whether to sell a stock that's down 10% or to take profits on one that's up 20%. The narrative of their financial life is a story written only by their yes decisions. The great, gaping flaw in this approach is that their most catastrophic mistakes are rendered completely invisible. They have no system for tracking their no decisions. Think of the average investor in the early 2010s. They might have looked at a company like Netflix. They understood the business streaming movies for a monthly fee. They used the service and loved it. They saw its growth. They did some analysis and thought, this looks like a great company. But then they looked at the valuation. It seemed expensive. The media was full of stories about its content spending and competition. So they hesitated. They passed. They decided not to buy it. And then, they forgot about it. They moved on to the next idea, the next stock to buy or sell in their visible portfolio. They never created a record of that no decision. They never wrote down their thesis and their reasons for passing. Consequently, as Netflix went on to multiply in value 10, 20, 30 times over, they never experienced the full, quantified pain of that error of omission. Their brain, seeking to protect their ego, would subconsciously rewrite history. They would tell themselves, oh, I never really understood their content strategy, or it was just a lucky gamble. They don't have a record to hold them accountable. This is the path of the 99%, a portfolio of small, obsessively managed commissions and a vast, unacknowledged graveyard of gargantuan omissions. This leads to a dangerously skewed perception of their own investment skill. They might sell a stock for a 30% gain and feel like a genius, while conveniently ignoring the 3,000% gain they forfeited on the company they understood but deemed a little too risky. They are learning from a tiny biased subset of their own decision-making. They are like a baseball player who only studies his strikeouts and never reviews the tapes of the perfect pitches he let go by without swinging. Without a rigorous process for tracking and learning from your omissions, you are doomed to repeat them, forever trapped in a cycle of small wins and invisible, life-altering losses. You are playing the wrong game, focused on avoiding small public embarrassments at the cost of missing huge private triumphs. The financial connection here is the most direct and brutal of all. The difference between this mindset and Buffett's is not theoretical. It is written in the cold, hard language of a balance sheet. For Buffett, the failure to act on Walmart in 1973 represents a phantom liability, an opportunity cost so immense it would have reshaped his financial reality. Let's make this tangible. In 1973, Berkshire Hathaway's total net worth was under $100 million. A hypothetical $50 million investment in Walmart that grew to $100 billion would have, by itself, been worth more than the entirety of Berkshire Hathaway was for the first several decades of its existence. A single yes instead of a no would have dwarfed the accumulated results of hundreds of other investment decisions. This is the ultimate demonstration of the power law in investing. A few decisions account for the vast majority of the results, and the most impactful decision is often the one you fail to make. This single error of omission had a direct, quantifiable impact on the compounding engine of Berkshire Hathaway for decades. Wealth management is not just about getting good returns. It's about the base of capital upon which those returns compound. Failing to add that massive tranche of Walmart capital in the 70s meant that for the 80s, 90s, and 2000s, Buffett's capital base was hundreds of billions of dollars smaller than it could have been. The subsequent returns, as magnificent as they were generated on a smaller foundation. The opportunity cost wasn't a one-time event. It was a permanent reduction in the trajectory of their financial compounding. For the individual investor, the principle is identical. The decision to not invest $10,000 in a company you truly understood and believed in, which then goes on to become $1 million position, is not a small mistake. It is the mistake that determines whether you achieve financial freedom or not. It is the decision that separates a comfortable retirement from a legacy of generational wealth. The direct financial connection is this: your net worth is not just the sum of your assets. It is the sum of your assets minus the ghosts of your unacted-upon convictions. And for most people, the ghosts are worth more than the assets. Recognizing this is the first and most important step toward exercising them. Once we understand the nature of omission, we must confront one of its primary causes: the insidious trap of waiting for the perfect moment, the perfect price, the perfect set of information. This is the paralysis of the perfect, a state of intellectual hibernation where the pursuit of certainty prevents the seizure of opportunity. Even the most decisive leaders can fall victim to this, getting so lost in the final details of analysis that they fail to see the bigger picture, a world-class asset slipping through their grasp. For this pillar, we turn to another of Buffett's multi-billion-dollar regrets, a story not of retail but of media dominance. It is the tale of his failure to purchase a television station in Dallas-Fort Worth, a decision that reveals how the hunger for a perfect bargain can lead to financial starvation. In the early 1980s, the television business was, in Buffett's own words, a gold mine. Local network affiliates were essentially unregulated monopolies. If you wanted to reach the eyeballs of a major metropolitan area, you had to go through them. This gave them incredible pricing power and astonishing profit margins. Buffett understood this business intimately. He had owned the Buffalo Evening News and was a major long-term investor in the Washington Post Company, which owned television stations. The economics of media were deep inside his circle of competence. An opportunity arose to buy WFAA-TV, the ABC affiliate in the rapidly growing Dallas-Fort Worth market, from its parent company, Belo Corporation. It was, by all accounts, a crown jewel asset, a dominant station in a booming Sunbelt metropolis. It was a license to print money. Buffett flew down to Dallas. He did the work. He analyzed the financials, assessed the market, and understood the durable competitive advantages the station possessed. He was ready to make a deal. He entered into negotiations with the sellers and offered what he believed was a fair price, somewhere in the ballpark of a few $100 million. The sellers countered with a price that was only slightly higher. The gap between them was not a chasm. It was a crack. It was a negotiable difference, likely a single-digit percentage of the total deal value. But Buffett, the consummate bargain hunter, balked. He had a number in his head, a vision of the perfect price. And he was not willing to budge. He engaged in what he would later call thumb-sucking, a prolonged period of hesitation and haggling over a relatively minor sum. He held firm to his offer, the seller held firm to theirs, and the deal fell apart. He walked away. The consequences of this paralysis were, once again, staggering. The media landscape continued to be incredibly profitable for decades. That station, WFAA-TV, would go on to generate billions of dollars in cash flow for its owners. Had Berkshire Hathaway owned it, that cash would have been funneled back to Omaha to be redeployed into other investments, further fueling the compounding machine. Buffett himself has lamented this mistake publicly, framing it not as a pricing error but as an intellectual failure. He knew it was a phenomenal business. He had the money. He was in a position to act. But he let the allure of a perfect entry point blind him to the far greater value of simply owning a wonderful asset for the long term. He won the battle of the negotiation, refusing to overpay. But he lost a war that was worth billions. This story is a powerful illustration of how an obsession with precision can lead to a massive error in overall judgment. It's a lesson that a great opportunity at a fair price is far superior to a fair opportunity at a great price. Waiting for the latter often means you get neither. The psychological force behind Buffett's thumb-sucking is a powerful and common cognitive bias known as analysis paralysis, which is fueled by a deeper craving for what we can call the certainty illusion. Analysis paralysis describes a state where an individual or group becomes so lost in the process of analyzing and evaluating data that they are unable to make a decision. It's a state of intellectual quicksand. The more you struggle, the deeper you sink. This is not caused by a lack of information, but often by an excess of it. In the world of investing, there is a limitless supply of data points to consider: macroeconomic trends, competitor actions, quarterly earnings, analyst reports, technical chart patterns. It is always possible to justify waiting for one more piece of information, one more confirmation that your thesis is correct. This desire for more data is driven by the certainty illusion, the brain's deep-seated belief that if we just try hard enough we can predict and control an inherently uncertain future. The human mind abhors ambiguity. It seeks clear, linear, cause-and-effect narratives. When faced with a complex decision like a major capital allocation, the brain wants to find the perfect answer, the one that eliminates all risk. But in investing and in business, there is no such thing as perfect certainty. Every decision is a probabilistic bet. The illusion that you can wait for risk to disappear is just that, an illusion, and it is a costly one. The time you spend seeking that final illusory data point is the very time in which the opportunity window is closing. Competitors are acting, prices are moving, and the world is changing. In the case of the Dallas-Fort Worth TV station, Buffett had all the critical information he needed. He knew the industry was fantastic. He knew the asset was a local monopoly. He knew the market was growing. The only uncertainty was whether he could get it for price X or price Y. By focusing excessively on that minor variable, he became paralyzed. He allowed the desire for the perfect price, the desire for certainty that he was getting the absolute best deal possible, to override the far more important conclusion that owning this asset, even at a slightly higher price, was a phenomenally good decision for the long run. This is a trap that snares the most intelligent people. Their analytical skills, which are normally a great strength, become a weakness. They can see the problem from so many angles that they become immobilized by the complexity they themselves have created. Overcoming this requires a shift in mindset, from seeking certainty to becoming comfortable with ambiguity, and from trying to make the perfect decision to simply making a very good decision and then moving on. To escape the trap of analysis paralysis, we need a practical mental model that helps us differentiate between decisions that require exhaustive analysis and those that demand swift action. The most effective framework for this is the two-way door versus one-way door model, a concept central to the executive decision-making process at Amazon. This blueprint is about categorizing decisions based on their consequences and reversibility. Here's how to apply it as an investor or business leader. Step 1 is the categorization itself. Before you begin your analysis, ask the fundamental question: is this decision a one-way door or a two-way door? A one-way door decision is one that is irreversible or very difficult and costly to reverse. These are decisions with highly consequential permanent outcomes. Examples might include selling your family business, taking a company public, or making a massive company-altering acquisition that fundamentally changes your balance sheet. For these decisions, you must proceed with extreme caution. You should engage in deep, slow, and meticulous analysis. You should measure twice, 3 times, and cut once. A two-way door decision, on the other hand, is reversible. If you make the decision, and it turns out to be a mistake, you can walk back through the door, undo the decision, and end up back where you started with minimal long-term damage. The vast majority of decisions, including most investment decisions, fall into this category. If you buy a stock and your thesis proves wrong, you can sell it. You might lose some money, but the decision is not permanent. You haven't bet the entire farm. Buffett's decision on the Dallas TV station was a two-way door. If he had paid a little more and the industry soured, he could have sold the station later. His reputation would not have been ruined. Berkshire would not have gone bankrupt. Step 2 is to adjust your decision-making process based on the door type. If it's a one-way door, use the paralysis of the perfect to your advantage. Overanalyze. Be paranoid. Wait for as much certainty as you can get. But if, and only if, it's a two-way door, you must adopt a bias for action. The goal is not to have 100% of the information. The goal is to act when you have a high probability of being right. The practical rule here is the 70% rule. If you have gathered about 70% of the information you wish you had, you should probably make the decision. Waiting for the final 30% will likely take more time than it is worth, and the opportunity may vanish in the interim. This framework short-circuits analysis paralysis by giving you permission to act under uncertainty for the vast majority of decisions you face. It recalibrates your mindset from a futile search for perfection to a pragmatic execution of high-probability bets. It's the tool that would have pushed Buffett through the door in Dallas. The antithesis of this decisive, action-oriented approach is a character every one of us knows. It is the permabear, the eternal student of the market. This is the individual who is often brilliant. They read voraciously. They understand complex financial concepts. They can articulate with stunning clarity all the reasons why the market is currently overvalued, why a crash is imminent, and why it is a terrible time to invest. Their analysis is often logical, well-researched, and compelling. They have successfully avoided every market downturn of the last 30 years. The only problem is that they have also successfully avoided every market upturn. Their path is the ultimate expression of the paralysis of the perfect. These individuals are trapped in a state of perpetual intellectual seeking. They are always waiting for the perfect signal, the fat pitch so obvious and risk-free that it requires no courage to swing. They are waiting for the market to crash by 50%, for valuations to return to historical lows, for all geopolitical uncertainty to vanish. They are waiting for a moment of perfect clarity that will never arrive. Their intelligence has become their own worst enemy. They can construct such a powerful and articulate case against action that they have convinced themselves that the safest course is to remain in cash, indefinitely. Their portfolio is pristine. It has no errors of commission. They have never lost money on a bad stock pick because they have never picked any stocks. But their balance sheet is a wasteland of errors of omission. By waiting for the perfect moment since 2011, they missed one of the most powerful and sustained bull markets in history. The opportunity cost of their inaction is not measured in percentages. It's measured in multiples of their initial capital. They may have preserved their $100,000, but they forfeited the chance for it to become $1 million. They chose the certainty of zero returns over the uncertainty of spectacular returns. The path of the 99% is often paved with good intentions and intelligent analysis. But analysis without action is merely a hobby. It generates no wealth. It builds no businesses. The perma-bear is a tragic figure, a person whose intellectual rigor prevents them from achieving the very financial freedom they so deeply desire. They have perfected the art of not losing, but in doing so have forgotten how to win. The financial connection between the paralysis of the perfect and your net worth is devastatingly clear. Let's return to the Dallas-Fort Worth television station. The gap between Buffett's offer and the seller's asking price was likely a few tens of millions of dollars. Let's be generous and say it was $50 million. In the context of a deal worth hundreds of millions for an asset that would generate billions in future cash flow, this is a rounding error. However, the psychological weight of overpaying by that amount paralyzed the decision. What was the financial result? By saving $50 million in the negotiation, Buffett forfeited billions of dollars in long-term value. This is the definition of being penny-wise and pound-foolish, scaled up to an epic level. This demonstrates a critical principle of capital allocation. For a truly wonderful, long-term asset, the price you pay is often one of the least important variables. A great business will bail you out of a slightly imperfect entry price. Its intrinsic value will compound so rapidly that any small premium you paid at the beginning will become irrelevant over time. Conversely, a mediocre business at a bargain price is still a mediocre business. Its poor economics will ensure that your returns are lackluster, no matter how great a deal you got. The 99% of investors spend 80% of their time trying to find the perfect price for mediocre businesses. The truly great investors, the ones with a true CEO mindset, spend 80% of their time trying to identify the truly great businesses. They know that the business quality is what drives long-term returns, not the entry multiple. By letting the perfect become the enemy of the good in that Dallas negotiation, Buffett made a decision that directly and permanently lowered the future net worth of Berkshire Hathaway. It was a multi-billion-dollar lesson in the reality that in the world of investing, it is far better to be approximately right than precisely wrong. This leads us to a fascinating and complex pillar of the Buffett philosophy, the circle of competence. This famous mental model instructs investors to only operate in areas they thoroughly understand. It's a powerful defensive tool designed to prevent foolish mistakes, errors of commission. But what happens when an opportunity is squarely tempting side circle, yet you still fail to act? This is where the circle of competence can become a double-edged sword. It can transform from a shield that protects you into a cage that imprisons you, preventing you from seizing opportunities that your own intellect has already validated. The most powerful example of this in Buffett's career is not a story about a newspaper or a candy company. It is the story of the 21st century's greatest business, and it is the story of his failure to invest in Google. In the early 2000s, Google was already a public company and a dominant force in the emerging world of internet search. But it was still, in the grand scheme of things, relatively small compared to the titan it would become. During this period, the founders of Google, Larry Page and Sergey Brin, made a pilgrimage to Omaha to meet with Warren Buffett. They explained their business model to him in detail. They described the AdWords auction system, a mechanism where advertisers bid to have their links appear next to search results. It was a system that monetized user intention with breathtaking efficiency. Buffett, listening to this, had a moment of profound recognition. He has stated publicly, on multiple occasions, that he and Charlie Munger understood the business model perfectly at that moment. They saw it for what it was, one of the greatest businesses they had ever seen. Let's analyze why it was so obviously within their circle of competence, not from a technological perspective but from a business principles perspective. First, it had an incredible moat. Google's market share in search created a network effect. More users led to more data, which improved the search results, which attracted more users. More users also attracted more advertisers, making the platform more valuable, which attracted even more advertisers. It was a self-reinforcing cycle of dominance. Second, it had unbelievable returns on capital. Unlike a railroad or a factory that required massive ongoing investment, Google's business model was capital light. It was a digital toll booth on the information superhighway, collecting a small fee from millions of transactions every day. The economics were sensational. Buffett understood moats and returns on capital better than anyone. He understood the concept of a toll booth business. And yet he did nothing. He passed. Why? By his own admission, it was because the company's name was Google. It was a tech company. It felt outside of his traditional hunting ground of insurance, banking, and consumer staples. Even though he grasped the asterisk fundamental business logic with perfect clarity, the technological wrapper made him feel like an outsider. The label technology acted as a psychological barrier. His own powerful rule, the circle of competence, which was designed to keep him from making stupid mistakes in areas he didn't understand, ironically prevented him from making a brilliant investment in a business whose economics he understood as well as any he had ever seen. He was so accustomed to analyzing companies through his traditional lens that he failed to see that the underlying principles were identical. This was not a failure to understand the business. It was a failure to overcome his own self-imposed labels. It was a multi-hundred-billion-dollar error of omission, born from the misapplication of an otherwise brilliant rule. The psychological phenomenon at the heart of Buffett's Google mistake is known as the Einstellung effect, a form of cognitive entrenchment. The Einstellung effect is a cognitive trap where a person's predisposition to solve a problem in a specific, familiar way prevents them from seeing a better or even an equally valid but different solution. The word Einstellung is German for mindset or attitude. Once we find a successful solution to a problem, our brain tends to lock onto that method, applying it over and over again, even in situations where it is not the most appropriate tool. For Buffett, his time-tested and wildly successful method was to analyze businesses with long histories, tangible assets, and predictable cash flows, companies like Coca-Cola or See's Candies. This was his Einstellung. When Google came along, he saw the business model clearly, but it didn't fit his established pattern. It was a young company. Its assets were largely intangible, code and data centers, and its future, while promising, seemed more uncertain than that of a railroad. His brain, entrenched in its successful pattern, defaulted to a pass decision, because the surface characteristics of the company did not match the template he had used for decades. He failed to transfer his fundamental analytical skills from the old domain to the new one. This is cognitive entrenchment. An expert becomes so steeped in their specific area of knowledge that they become rigid in their thinking, unable to adapt to new paradigms. They mistake the map for the territory. Buffett's map was drawn with the ink of industrial-era companies, and he struggled to see that the territory of business principles, moats, pricing power, returns on capital, was exactly the same in the digital age. It was a failure of cognitive flexibility. The very expertise that made him a genius in one domain temporarily blinded him in another, even when the underlying logic was the same. To overcome this, one needs to constantly fight against their own successful formulas and ask if the fundamental principles apply, even if the packaging is unfamiliar. The antidote to the Einstellung effect and cognitive entrenchment is a powerful mental model known as first principles thinking. Instead of reasoning by analogy, which is what Buffett did when he said Google is a tech company and I don't do tech, first principles thinking involves breaking down a complex problem into its most basic fundamental truths and reasoning up from there. It's about tearing off the labels and looking at the raw mechanics of the situation. This is the blueprint for how an investor can use this model to intelligently expand their circle of competence without becoming a reckless speculator. Step 1. Identify an opportunity that seems to be outside your circle. Let's take a modern example, a software as a service or SaaS company. For an investor comfortable with traditional manufacturing, this might seem like an alien world of churn rates and customer acquisition costs. Step 2. Instead of reasoning by analogy, I don't understand SaaS, you must begin breaking the business down to its first principles. Ask fundamental questions. How does this business make money? The answer: It charges customers a recurring fee for access to its software. Immediately, a first principle emerges. This is a subscription business. Step 3. Deconstruct the business further using questions you would ask of any company. How does it acquire customers? Sales and marketing. How much does it cost to keep them? This relates to the product's quality and stickiness. What is its pricing power? Can it raise prices without losing customers? What are the returns on tangible capital? Likely very high as the main asset is code. Is there a moat? Perhaps high switching costs or a network effect. Step 4. Compare these first principles to the principles of a business you too understand. An investor like Buffett understands the Wall Street Journal or a magazine publisher. What is a magazine? It's a subscription business. It has customer acquisition costs. It has a renewal rate, the opposite of a churn rate. It has pricing power if its content is unique. Suddenly, the SaaS company doesn't look so alien. Its economic engine, at a first principles level, is remarkably similar to a business he has understood for 50 years. By using this method, you are not abandoning your circle of competence. You are expanding it from its core. You are building a bridge of logic from what you know to what you don't. This model allows you to analyze any business, no matter how novel its technology, by focusing on the timeless, unchanging laws of economics and human behavior. It is the tool that would have allowed Buffett to see Google not as a tech company, but as one of the greatest royalty and advertising businesses ever conceived. The opposite of this principled, deliberate approach is the path of the 99%, the diversification investor. This is the person who commits the inverse error of Buffett with Google. While Buffett's overly rigid adherence to his circle led to a massive error of omission, this investor's complete lack of a circle leads to a constant stream of catastrophic errors of commission. They operate with no framework, no guiding principles, and no self-awareness. Their investment strategy is a chaotic whirlwind of chasing hot trends and popular narratives. One year, they are all in on cannabis stocks because they read an article saying it's the next big thing. They don't understand the regulatory landscape, the competitive dynamics, or the economics of cultivation. They just know it's hot. When that fails, they pivot to cryptocurrency, buying obscure altcoins based on a tip from a friend of a friend. They can't explain what a blockchain is, but they are certain it's the future of finance. Then it's on to meme stocks, piling into a struggling retailer because of a frenzy on a social media forum. Their portfolio is a chaotic museum of failed fads and burst bubbles. This behavior is the antithesis of the circle of competence. It is action without understanding. It is gambling masquerading as investing. They are committing the cardinal sin that the circle of competence was designed to prevent. The lesson here is profound. The circle of competence is not an enemy to be defeated. It is a critical foundation to be respected and built upon. The 99% fail because they have no foundation at all. Buffett's error with Google was a high-class problem. It was the mistake of an expert failing to stretch. The average investor's mistake is far more basic. It is the mistake of a novice wandering into a minefield. The solution is not to abandon the circle, but to treat it as a living thing. It must be a membrane, not a wall. You must master your core competency, and then, using first principles thinking, deliberately and carefully expand its borders, one adjacent competency at a time. The goal is to avoid both the rigid prison of overspecialization and the chaotic wilderness of rank amateurism. The financial connection of this principle is a tale of two extremes. On one side we have Buffett's error of omission with Google. Let's quantify it. If Berkshire Hathaway had invested just $10 billion in Google in the mid-2000s, a significant but not company-betting sum for them at the time, that stake would today be worth well over $500 billion. It would be, by a huge margin, the single greatest investment he ever made, eclipsing even his legendary success with Apple. The cost of his cognitive entrenchment, the cost of failing to apply his fundamental business principles to a new domain, is a number so large it's hard to articulate. It represents a monumental loss of potential wealth for his shareholders. On the other side we have the diversification investor. The financial connection for them is a slow, or sometimes rapid, erosion of capital. Their portfolio statement is a sea of red. The $100,000 they started with becomes 80, then 60, then 40. Their constant pursuit of commission in areas they don't understand leads to a guaranteed outcome: the transfer of their wealth to those who do. The comparison of these two outcomes reveals the core truth. The financial consequence of a single, massive error of omission, like passing on Google, can be greater than the cumulative financial consequence of thousands of small errors of commission. Buffett's most famous commission error was his purchase of Dexter Shoes, a business whose competitive advantage was eroded by foreign competition. He has stated that mistake cost Berkshire several $100 million. That's a painful loss. But it is a tiny fraction of the hundreds of billions he lost by omitting Google. This stark mathematical reality should reframe every investor's approach to risk. The greatest financial risk is not losing a little money on a bad idea you pursued. The greatest financial risk is missing out on the life-changing gains of a great idea you understood but were too timid or too rigid to embrace. We have now seen how errors of omission are born from haggling over price, from analysis paralysis, and from the misapplication of our own best rules. This raises a critical question: how do you learn from a mistake that is invisible? How do you correct a flaw in your decision-making if you have no record of the decision itself? The answer lies in the fourth pillar: the discipline of quantifying the invisible by creating and tracking an anti-portfolio. This is not just a theoretical concept, it is a practical, rigorous habit of mind championed by Buffett's partner, Charlie Munger. It is the process of making your invisible mistakes visible so you can turn your financial regrets from sources of pain into engines of learning. The foundational anecdote for this pillar is not a single transaction, but a lifelong behavior embodied by Charlie Munger. Munger is the conscience of Berkshire Hathaway, the man whose job it is to constantly challenge Buffett's thinking and, most importantly, to remind him of their mistakes. If you listen to interviews and Berkshire Hathaway shareholder meetings over the decades, you will hear a recurring theme from Munger. He is the one who most often and most bluntly brings up the colossal opportunities they missed. He talks about Walmart. He talks about other retailers they understood and passed on. He has publicly stated that they should have a portfolio of shame that tracks all the great businesses they failed to buy. This is not an act of self-flagellation. It is an act of supreme intellectual honesty. Munger understands a fundamental truth about human nature: we are all masters of self-deception. It is easy to look back at a missed opportunity and rationalize our inaction. He combats this by keeping the mistakes alive. He forces himself and Buffett to continually re-examine their errors of omission, not to wallow in regret but to extract every last ounce of wisdom from them. He is creating a feedback loop for their inaction. By talking about these omissions as if they were real losses, he makes them tangible. He gives them weight in their decision-making process. This relentless focus on what they didn't do is a core part of Berkshire's cultural DNA. While other companies celebrate their successes, Berkshire has a parallel culture of rigorously studying their failures, especially the silent, invisible failures of omission. Munger's habit is the anecdote. It's the story of a man who understood that to get better, you must be willing to stare your biggest mistakes in the face even, and especially, the ones no one else can see. He is a venture capital investor in reverse, studying not the companies he backed, but the unicorns he let get away, a practice that sharpens his judgment for the next opportunity. The psychological enemy that Munger's discipline is designed to combat is a powerful duo of cognitive biases: hindsight bias and the narrative fallacy. Hindsight bias is the pervasive human tendency to perceive past events as having been more predictable than they actually were. It's the "I knew it all along" phenomenon. Once we know the outcome of an event, a stock soaring, an election result, our brain subconsciously reconstructs our memories to make it seem like that outcome was obvious from the beginning. If an investor passes on a stock that subsequently skyrockets, hindsight bias will tempt them to forget their initial uncertainty and doubt. Instead, they might misremember thinking it was a good idea, but were just unlucky or distracted. This bias makes it nearly impossible to learn from the past because it distorts our memory of our own state of mind at the time of the decision. Compounding this is the narrative fallacy, a concept popularized by Nassim Nicholas Taleb. This is our tendency to create simple, coherent, and often flawed stories to explain complex past events. We crave narratives because they make the world feel more orderly and predictable. An investor who missed Amazon might create a narrative like, "It was impossible to predict the rise of cloud computing." While this story might be comforting, it is likely an oversimplification that masks the real reason for their inaction, which might have been a simple lack of diligence or courage. The anti-portfolio is a direct weapon against both of these biases. By creating a written record of your decision asterisk at the time it was made, you are creating an immutable piece of evidence. You are freezing your state of mind. When you review your anti-portfolio a year later, you cannot fall for hindsight bias. Your own handwriting will tell you exactly what you were thinking and why you decided to pass. You cannot invent a comforting narrative, because the real messy and uncertain reasons for your decision are written right there on the page. The anti-portfolio is a tool of radical self-honesty. It short-circuits your brain's natural tendency to lie to itself, forcing you to confront the reality of your own judgment, or lack thereof. This brings us to the blueprint, the practical application of this discipline, creating your own investment decision journal and anti-portfolio. This is one of the highest leverage activities an investor can undertake, and the cost is merely a notebook and a commitment to honesty. Here is the step-by-step process. Step 1. Acquire a journal, either physical or digital. This will be the repository for your thinking. Step 2. For every significant investment you decide to make a nick, you must create an entry. Write down the date, the name of the company, the price, and, most importantly, your investment thesis. Write a few clear paragraphs explaining why you believe this is a good investment. What are the key drivers? What is the moat? What are the risks? This is your portfolio entry. Step 3. This is the crucial part. For every significant investment that you seriously analyze, believe is a good idea, but ultimately decide to pass on, you must create an identical entry. This is your anti-portfolio. Write down the date, the company name, the price at which you considered it, and a detailed explanation of why you are passing. Be brutally honest. Is it because the price is too high? If so, what price would make you a buyer? Is it because of a specific uncertainty about the industry? Articulate that uncertainty. Is it because it falls just outside your circle of competence? Explain why. This act of writing crystallizes your reasoning and prevents future rationalizations. Step 4. Schedule a recurring appointment with yourself, perhaps quarterly, to review your journal. Look at your portfolio entries. How are your actual investments performing relative to your original thesis? Were you right for the right reasons? Now look at your anti-portfolio entries. Track the performance of the companies you passed on. If a company you rejected has done poorly, read your reasoning. Did the risks you identified come to pass? If so, that's a validation of your judgment. But if a company you rejected has performed spectacularly, you must study your entry with the intensity of a detective studying a cold case. What did you miss? Was your valuation framework too rigid? Did you underestimate a competitive advantage? Were you simply too fearful? This systematic review creates the feedback loop that Charlie Munger cultivates. It turns your financial regrets into your most valuable case studies. It is the single best way to get better at the art of capital allocation. The antithesis to this disciplined, reflective practice is the outcome-oriented investor. This is the path of the vast majority. This person judges the quality of their decisions solely based on the outcome. The process is irrelevant. If they buy a stock and it goes up, they conclude it was a brilliant decision. If they buy a stock and it goes down, they conclude it was a stupid decision. They live in a world devoid of nuance, a world where luck is indistinguishable from skill. The fundamental problem with this approach is that the world is probabilistic. You can make a very good, well-reasoned decision that, due to bad luck, has a negative outcome. A great company can be derailed by an unforeseen event. Conversely, and more dangerously, you can make a terrible, reckless decision that, through sheer dumb luck, has a positive outcome. You can buy a speculative stock on a whim and have it double. The outcome-oriented investor who gets lucky learns the wrong lesson. They conclude that their reckless process was actually skillful, reinforcing a bad habit. They are doomed to repeat their bad process until their luck inevitably runs out. Because they do not journal their decisions or track their anti-portfolio, they have no way of decoupling process from outcome. They are constantly being fooled by randomness. They attribute all their successes to their own genius and all their failures to external factors, market manipulation, bad press, the Federal Reserve. This is a recipe for long-term failure because it makes genuine learning impossible. To improve as a decision-maker, you must be a ruthless critic of your own process, regardless of the outcome. The anti-portfolio is the ultimate tool for this, as it allows you to analyze your thinking on a company that, quote, got away, completely separating your process from the random noise of your own portfolio's daily fluctuations. The outcome-oriented investor is trapped on a hamster wheel of repeating their mistakes. The journal keeper is on an upward spiral of continuous improvement. The direct financial connection of keeping an anti-portfolio is perhaps the most profound of all. On the surface, the connection is about quantifying opportunity cost, as we've discussed. Seeing in black and white that your decision to pass on a company cost you a potential $100,000 gain is a powerful motivator. But the true financial impact is far deeper. It is about the compounding of knowledge. Investing is a skill, and like any skill, it improves with deliberate practice and feedback. The investment journal is your system for deliberate practice. By systematically reviewing your past decisions, both your commissions and your omissions, you begin to spot patterns in your own thinking. You might discover, for example, that you have a consistent tendency to underestimate the power of network effects. Or you might find that you are too anchored to outdated valuation metrics like low price-to-earnings ratios, causing you to miss high-growth businesses. Once you identify these systematic flaws in your process, you can correct them. This correction is what generates the astronomical financial returns. By fixing a flaw in your process, you don't just avoid one future mistake, you avoid an entire category of future mistakes. The $10 notebook you use for your journal, by helping you identify a single recurring flaw in your capital allocation process, could prevent a future multi-million-dollar error of omission. The return on investment for that notebook is effectively infinite. This is how the best get better. They are not just compounding their capital, they are compounding their wisdom. The ultimate driver of long-term financial success is the quality of your decision-making. The anti-portfolio is the single most effective tool for systematically improving that quality. Its financial value isn't measured in the performance of a single stock, but in the upward trajectory of your entire financial life. This entire exploration of defining omission, overcoming paralysis, expanding our competence, and tracking our failures all leads to a final, crucial pillar. All the analysis in the world is useless without the will to act. The ultimate solution to the problem of omission is the deliberate construction of conviction and the courage to make a significant bet when your analysis tells you the odds are overwhelmingly in your favor. This is the architecture of conviction. It's about building a personal operating system that transforms intellectual understanding into decisive action. And there is no greater story of this principle in action than Warren Buffett's career-defining investment in American Express during the Salad Oil scandal. The year was 1963. American Express was primarily known for its traveler's checks and credit card-like services, a business built on the bedrock of trust. A major division of the company, however, was in the seemingly mundane business of field warehousing. They would inspect a company's inventory and issue warehouse receipts against it, which that company could then use as collateral for loans. One of their largest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis. The problem was, DeAngelis was a fraud on a colossal scale. His giant storage tanks in Bayonne, New Jersey, which were supposed to be filled with valuable salad oil, were mostly filled with seawater, with only a thin layer of oil floating on top to fool the inspectors. When the fraud was discovered, Allied crude collapsed, leaving banks holding worthless receipts for millions of gallons of non-existent oil. The market panicked. The assumption was that American Express, having issued the receipts, would be on the hook for the massive losses, which were estimated to be larger than the company's entire net worth. Wall Street concluded that American Express was headed for bankruptcy. The stock, which had been trading at over $60 a share, collapsed to $35. Warren Buffett, then a young, relatively unknown money manager in Omaha, watched this unfold with intense interest. But instead of joining the panic, he began to do his own research, what he called scuttlebutt. He didn't just read the papers, he went out into the real world to test his thesis. His thesis was that the scandal, while serious, had not damaged the fundamental underlying businesses of American Express, the traveler's checks and the cards. He went to restaurants and travel agencies, he talked to clerks and customers, he observed. And what he saw was that people were still using the traveler's checks. Businesses were still accepting the cards. The brand's reputation with the actual public was intact. He concluded that the value of the core franchise dwarfed the potential liabilities from the salad oil fraud. He developed deep, evidence-based conviction. And then, he acted with extraordinary courage. He invested 40% of his entire investment partnership, a massive, concentrated bet, into the stock of American Express. It was the single largest investment he had ever made. He was betting against the entire market, against the prevailing narrative of doom, based on his own independent work. The market was focused on the visible scandal. Buffett was focused on the enduring, invisible franchise. He was right. American Express survived, the stock roared back, and that single decision made a fortune for his partners and cemented his reputation as a fearless, conviction-driven investor. To build the kind of courage Buffett demonstrated with American Express, one must understand the psychological forces that create panicked herds and reward contrarians. The first principle is a sort of Dunning-Kruger effect in reverse. The Dunning-Kruger effect famously describes how people with low ability at a task tend to overestimate their ability. To have true conviction, you need the opposite, a well-calibrated and accurate assessment of your own high level of knowledge in a specific area. You have to know what you know. Buffett had spent years studying financial companies and brands. He had a deep understanding of the economics of trust. His confidence wasn't arrogance. It was the earned result of intense preparation meeting opportunity. Genuine conviction can only be built on a foundation of genuine competence. The second principle at play is pluralistic ignorance. This is a fascinating social psychological phenomenon, where a majority of individuals in a group privately reject a particular belief or norm, but they go along with it publicly because they incorrectly assume that most other people accept it. In a market panic, almost every individual investor might have a private, nagging feeling that the sell-off is irrational. They might look at American Express and think, people are still going to use traveler's checks, but they see the stock price plummeting. They read the fearful headlines, and they assume that all the asterisk other sellers must know something they don't. So, they suppress their own judgment and join the herd, selling their shares to protect themselves. This creates a cascade of selling based on a shared illusion. The courage to be a contrarian is, in fact, the courage to break this spell of pluralistic ignorance. It is the willingness to trust your own analysis over the emotional temperature of the crowd. Buffett in 1963 was not a reckless gambler. He was a clear-eyed rationalist who saw that the entire market was in the grip of a collective delusion, and he had the fortitude to act on that insight. Conviction, therefore, is not just about analysis. It is about the psychological strength to stand alone when your analysis tells you the crowd is wrong. This brings us to our final blueprint, the operational model for turning all of this theory into a system for action, the conviction checklist and bet-sizing model. This is how you build a repeatable process for making high-stakes decisions with courage and clarity. Step 1 is to develop your personal conviction checklist. Before you can have conviction in an investment, it must pass a series of rigorous, predefined tests. This is not a generic checklist. It is one you build yourself based on your own circle of competence and investment philosophy, inspired by the greats. It might include questions like, can I explain this business to a 10-year-old in a single sentence? Does the business have a durable competitive advantage, a moat? Is the management team both talented and honest? Is the balance sheet strong enough to withstand a severe recession? Does the business generate high returns on the tangible capital it employs? An opportunity must get a clear yes on every single one of your critical checklist items before it can even be considered for a high-conviction bet. Step 2 is to conduct a pre-mortem. This is a powerful technique for stress testing your own conviction. Imagine it is 1 year in the future, and your investment has failed catastrophically. Now, write the story of why it failed. What went wrong? Did a competitor emerge? Did the technology become obsolete? Did management make a critical error? Force yourself to write down the 3 most compelling arguments for why you are wrong about this investment. Then, and this is the crucial part, you must systematically find evidence to debunk each of those arguments. If you cannot find compelling counter-evidence, then your conviction is built on hope, not on solid ground, and you must not proceed with a large bet. Step 3 is to translate your psychological conviction into a financial decision through intelligent bet sizing. Your position size should be a direct reflection of your level of conviction. A low conviction idea might warrant a 1% portfolio allocation. A medium conviction idea, 3 to 5%. But for those rare opportunities, like Buffett's American Express, where it passes every item on your checklist, where you have systematically debunked the bear case in your pre-mortem, and where the valuation is highly attractive, that is when you must have the courage to make a significant bet. You can use a conceptual framework like the Kelly criterion, which mathematically links the size of a bet to your perceived edge. The core idea is simple. When you have a massive edge, you must bet big. This systematic process, checklist, pre-mortem, bet sizing, is the architecture. It transforms conviction from a vague feeling into a rigorous, repeatable process that allows you to act with decisive courage when the opportunity of a lifetime appears. The antithesis of this conviction-driven approach is the diversified dabbler. This is the investor whose portfolio is a monument to their lack of conviction. They own 100, sometimes 200 different stocks. They have a tiny slice of everything they've ever heard recommended. A little bit of this tech stock, a little of that industrial, a small position in an emerging market fund. Their strategy is, in effect, to own the haystack in the hopes of finding a needle. They have so many positions that they cannot possibly keep up with the businesses they own. They haven't read the annual reports. They don't know who the CEOs are. They are not investors. They are collectors of financial instruments. This path of diversification is born from a deep-seated lack of confidence. The dabbler does not have the courage to make a meaningful bet on their own best ideas, so they make a series of meaningless bets on everyone else's. They are terrified of the risk of being wrong on any single position, so they ensure that no single position can ever make them truly wealthy. Their financial future is tethered to the law of averages. They will never suffer a catastrophic loss from a single stock going to zero, but they have also completely eliminated the possibility of experiencing the life-altering returns that come from a concentrated position in a generational company. They have chosen the certainty of mediocrity over the possibility of greatness. Their portfolio is a perfect reflection of their mindset, a scattered, unfocused collection of maybes. They have perfectly insulated themselves from the risk of commission, but in doing so have guaranteed themselves a lifetime of omission, forever missing the explosive upside that only comes from concentrated conviction-driven action. The direct financial connection of conviction is the engine of all great fortunes. Let's look at the numbers from the American Express salad oil scandal. Buffett invested roughly $13 million of his partnership's capital. Over the next few years, as the market realized the underlying business was sound, The stock quintupled. That single, concentrated bet generated a massive return that supercharged the performance of his entire partnership and laid the financial and reputational foundation for what would become Berkshire Hathaway. It was a clear demonstration that financial breakthroughs are not the result of 100 timid decisions. They are the result of a handful of bold, courageous actions taken when analysis and opportunity align perfectly. This is the ultimate financial payoff for overcoming the error of omission. By building a system to generate true conviction, you give yourself permission to act decisively. This is how wealth is truly built. Not by spreading your capital thinly across dozens of mediocre ideas, but by concentrating it heavily in a few extraordinary ones. Your financial success in life will likely not be determined by the average return of all your ideas, but by the performance of your best 5 ideas. The architecture of conviction is the system you use to identify those 5 ideas, and to give you the courage to bet on them in a way that matters. It is the final link in the chain, the mechanism that converts all your hard work, analysis, and psychological fortitude into a tangible, and often massive, financial result. It is the difference between a life of watching from the sidelines and a life of being in the game, playing to win. You have just spent this time recalibrating the very lens through which you view success and failure. You have acquired a powerful mental tool, the framework for understanding and combating the silent wealth destroyer known as the error of omission. You now understand that the opportunities you see, analyze, and fail to act on are not minor missteps. They are the defining and often most costly decisions of your financial life. You have moved from focusing only on the visible scars of your bad decisions to seeing the vast invisible ghosts of your inaction. This is a profound shift in perspective, one that separates the amateur from the professional in the high-stakes game of capital allocation. But this framework, as powerful as it is only one part of a larger, interconnected system of thought. Knowing how to overcome the fear of inaction, knowing when to act with courage and conviction, is the engine. But an engine is useless without a target. The error of omission framework is your trigger, but you still need a world-class target identification system. The next critical question, the one this entire model depends upon, is this: what constitutes a truly great business, a fat pitch that is actually worthy of this level of conviction? How do you know when the opportunity in front of you is one of the 1 in 1,000 chances that can change your life, versus the hundreds of mediocre ideas that will lead to ruin? The video that is now on your screen is designed to be that missing link. It is the next piece of the map. It provides the critical lens, the very framework for identifying the economic moats, the durable competitive advantages, and the management qualities that separate the truly exceptional businesses from the merely good ones. It is the system for identifying the targets that warrant the courage you are now learning to build. To understand one without the other is to have a sword with no knowledge of where to strike. The two models are designed to connect, to create a complete system for extraordinary decision-making. Mediocre investors focus on the mistakes they made. The future titans of industry and finance focus on the masterpieces they failed to create. This journey is about moving from one to the other, from a mindset of loss avoidance to one of relentless value creation. If you are committed to that path, the next step in your education is on the screen right now. Complete the model. Build your arsenal. The choice, as always, is yours.